In this presentation, we will continue on with our corporation comprehensive problem, taking a look at the statement of stockholders' equity. For more accounting information and accounting courses, visit our website at accountinginstruction.info. In prior presentations, we have put together the balance sheet, we have put together the income statement, we have found a home for our adjusted trial balance, finding a home for every account on the adjusted trial balance somewhere on the financial statements. We have done so for the assets, the liabilities, and the income statement accounts. The only accounts we haven't found a home for then are really just these dividends and the retained earnings. Once we do so, we will have tied everything together and we will be in balance and have found a home for all financial statements, and all the financial statements will be complete. We will do that by putting together the statement of stockholders' equity, finding a home for these last two accounts, and tying everything together, in essence tying out all these blue accounts, which are the equity section, which will then tie out to the balance sheet, and it'll show us net income as well, which will tie in the income statement. The statement of stockholders' equity will be a timing account like the income statement. In other words, it will have the phrasing of for the month ended January 31st, 2000X1 in this case. And that's as opposed to as of a point in time, which will just have one date. So we need to have that. We need to have timing. This is going to show us performance over time. Unlike the income statement, however, it's not going to start at zero. All the income statement accounts, in other words, are kind of like a stopwatch. We start them over and then they just go up from there. This statement of stockholders' equity will typically start at wherever the last point in time ended, and then we'll add to it and subtract what the activity will be to get to the ending point in time. So in other words, it's going to have the balance as of the beginning of the time period, January 1st, the balance as of the end of the time period, January 31st, and group together the kinds of activities that happened during that time period. Now, the only difficult thing about the statement of stockholders' equity, or the main difficult thing, is to know how to group the stockholder equity statement out. One reason this is difficult is because it's a little bit different depending on entity type. This statement will differ depending on type of entity. In other words, if it's a sole proprietor, then we only really have the total column. And if we concentrate on the total column, it's all pretty much the same. If we look at just total equity, it represents what's owed to the owner. And there might be multiple owners or one owner, but in total, it's what's owed to the owners. And that's going to be what it started at, what was owed to the owners at the beginning of the time period, plus what it increased by minus what it decreased by. That's going to be pretty much the same for any type of entity. What will differ, however, is the types of owner. If it's only one owner, you only need one column to do that. If you got two owners in a partnership or more, then you got to list it out by partner. The corporation is somewhat simpler, more simplified than a partnership, because we don't need to list all the partners or all the owners. That's the point of having common stock. So that's nice. We can have a whole lot of different owners. They can be trading stuff all the time in terms of stock, and we don't need to list out who they are on the statement of stockholders' equity. What we do is we break out between the initial investment of the owners and the earnings of the company that have been generated and not yet given out in terms of dividends, the retained earnings. And so that's going to be here, the common stock, additional paid in capital, representing the initial investment of the owner, what the owner put in the company for the initial investment. And then the retained earnings representing what has been taken out, what has earned in the company, less the dividends that have been given. Now, the beginning balance here is going to be, because it's the first month of operations, all zero. So the beginning balance is just going to be zero because it's the first month of operations. That will not typically be the case if it were not the first month of operations. In other words, if this were the second month of operations or any other month of operations, the common stock and additional paid in capital would probably already have been put into the business. In other words, we typically issue the common stock sometime at the beginning to gain capital, and then we don't issue common stock every time period. We're not going to be issuing common stock every month. And therefore, these two accounts, the 30,000 and the 70, if it wasn't the first month of operations, would probably have been there the entire month and therefore be part of this beginning balance. Because it is the first month of operations, we did issue them. How would we know that in practice? We'd look at the GL. We'd look at the activity and say, okay, is this what happened at the beginning of the month or was there activity? There's not going to be a lot of activity in the GL because these are types of accounts we don't do a lot with. It's not like cash where we're doing stuff to it all the time. So if we just look at the GL and say, okay, yeah, this was bought this time period, then it started at 0 and then we bought more of it. Retained earnings is similar in that this retained earnings only represents beginning retained earnings. If it was any other month other than the first month of operations, then that would be something other than 0. We would have some type of retained earnings from the prior periods of operations, in other words. Because it is the first month of operations, it is 0. Just note that this 0 represents the beginning balance number. This retained earnings, even though it says retained earnings on this trial balance, that supposedly as of the end of the month, as it will often say in the trial balance, it's really only the beginning of the month number because all of the activity is broken out into the temporary accounts. So retained earnings is really where most of the action will happen here because that's what we're going to change from the beginning to the end to get to total stockholders' equity. Now then we have the issuance of shares, and that's going to be basically the owner investing money into the company. And that was this $30,000. And this isn't going to happen every month again. So in this particular month, because it's the first month, we issued shares 30,000 and we got 30,000 for it plus the 70,000. So we know that we actually got 100,000. We issued them at 30,000. That's the par value. And then we got another 70,000 over and above that. So we issued them for 100,000 and $5 par value, 70,000 over and above. Then the retained earnings is at 0. So total then is 30,000 plus the 70. This is where we're starting at, or this is where the investments were through this time period. Then we've got net income. Net income is part of retained earnings. And that's, again, the only kind of tricky thing is, well, where do we put net income? Net income represents the revenue minus expenses. It's not part of the initial investment. It's not part of common stock or additional paid-in capital. It's part of the earnings that we have earned that we have not yet given out in the form of dividends or retained earnings. Now we could get this number from the income statement. We'll see that how that tries out, how that ticks out. But we also want to see it on the trial balance to see where these numbers are pulling from on the trial balance, which is, of course, the income statement numbers. We're grouping all the income statement numbers, revenue minus expenses, to the 7,100, not a credit here, but a positive number on the statement of equity, 7,100. And then if we pull the total over, 7,100. And then we have the draws here, or the dividends. And so the dividends are going to be here. Now, sometimes the dividends will just be taken straight to retained earnings, and we would have to know, how would we know then that there were dividends? We'd have to look at retained earnings, the GL, the activity for it, and pull out the activity that were dividends on it. Or in this case, we pulled out a dividends account separately, often how it is shown when we have a partnership or a sole proprietor, which is similar, dividends being similar to draws, representing money that was taken out of the company given to the owners in the form of dividends. So dividends are going to be reducing retained earnings. So note what we did with the language here. We said less dividends. I didn't represent the minus with a minus sign here. Some statements will, but oftentimes you'll just see it with words, and you just got to know what the convention is going to be. We know that dividends are going to decrease the retained earnings because dividends represent money that's going back to the owners. Total stockholders' equity represents the amount of the company that is owed to the owner, in essence. So if we paid back some of the dividends, that's going to reduce the amount that's owed to the owners. Kind of like if it was a liability and we had accounts payable and we paid back some of the accounts payable, well, then the liability would go down. From the perspective of the business being separate from the owners, the same thing is the case. All of these capital accounts are kind of like capital, kind of like liabilities. They're credits. They're what the company owes to the owner. And if we paid back the owner this amount, then it's going to bring down equity. We're going to bring that total over. So there's the 1,500. And then we're going to say that we have the balances that we're just going to bring down. So the 0 plus the 30,000 is 30,000 for the common stock. Additional paid in capital, 70,000. Retained earnings, 0 plus 7,000 minus the 1,500. That's often where people get messed up, is by adding these instead of subtracting them. And then we can calculate this one of two ways. We can take the 100,000 plus the net income, 7,001, minus the 1,500 to get the 105,600, or we can take the 30,000 plus the 70,000 plus the 5,600 to get the 105,600. We have now completed all the financial statements, and we found a home for everything on the trial balance, an individual home for everything on the trial balance. And we can just see that everything ticks and ties out. How? We can say all the yellow numbers tie out. In other words, we can see that assets equal liabilities plus equity. We can see that the net income, 7,100, is found on the statement of equity. And we can see that the bottom line of the statement of equity, 105,600, is found on the balance sheet. We can also see that the subcategories of the statement of equity are found on the balance sheet. So every time we look at the financial statements, we should basically be able to tie that out. When you think about this, you want to think, this is the big picture, balance sheet, big picture. All of this whole thing is represented on the balance sheet. The only problem is, the only reason the other two statements are needed is because we kind of grouped things together in this equity section. We summed things up. In particular, we summed up all of these accounts into one number on the equity section. So you can really think of these two accounts as breaking out this timing account. We took all these timing accounts and we made them into one permanent account. We took accounts that have a beginning and end and told us just what the end is by summing them up. Then we're telling the story basically of this 5,600 retained earnings through the income statement and the statement of equity. We're telling the activity that happened 1 year prior. That activity, of course, represented in the temporary accounts on the adjusted trial balance. For more accounting information and accounting courses, visit our website at accountinginstruction.info.